Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview, where every week we have a guest to join us and get an analytical look at the markets, the energy markets, of course, and the year ahead is what we're focusing on now in January, and what various analysts and participants in the markets see as the main pulls and pushes, if you like, where that market is going. And I'm delighted today to be joined by Mr. Clay Seigle, Director of Global Oil Service at Rapidan Energy Group, based in Houston. Thank you so much for joining us, Clay.
Thank you. It's a pleasure to be with you today.
Great, Clay. Well, we talk to many analysts on a daily basis, and I have to say, I've never seen or heard them be more confused or uncertain about where this oil market, let's start with oil markets, are going in the year ahead, let alone in the next quarter. Of course, we've had quite a volatile year last year in terms of prices, a lot of volatility, and we all know the factors that were sort of behind that. So, where would you say the market is at going forward in the first half of this year? Is it demand or supply factors that are going to be sort of clarifying the way forward for us more?
Well, that's a great framing question to begin our discussion. Certainly, both supply and demand will be paramount to price formation, as they always are. We think that in the beginning of the year, it's probably more of a story about supply concerns. And in the balance of the year, particularly when China begins to rebound in force with economic activity and consequent oil consumption patterns, then more turn to the demand side of the equation, probably in the second through fourth quarters of the year. So that's kind of how we're seeing the risk and opportunity profile shaping up at the beginning of the year. In the beginning, we're quite still focused on the prospect of a disruption of Russian oil supplies. It's the disruption that never materialized when the market was expecting it just about a year ago after the Russian invasion of Ukraine kicked off. But we do believe that we will see signs of just at least logistical troubles in redirecting some of those last barrels of Russian crude that have not already been redirected to Russia's continuing buyers after the European Union's import ban began in the beginning of December. And then likewise, as the refined products ban kicks in the beginning of February, we think that that'll be a little bit harder still for the market to rebalance, because there's simply just a bigger dislocation between Russian clean products, particularly gas oil, and demand around the world outside of Europe. So it should be a little bit incrementally harder for those barrels to get reshuffled than we had seen for crude.
Yeah, okay, and fair enough on the products, and that is the opinion that we've heard, actually, that the product price caps or sanctions are going to be trickier for Russia to maneuver, indeed for that product to be redirected to where it's needed. But what makes you say that the crude will have some disruption now, a disruption that we did not see actually last year yet? Do you think that we're going to start to see certain disruption to Russian crude? Why wouldn't it just
I think again on the logistical and operations side is where that would be manifest. So to be clear, as long as the price cap is set above the price of Urals, which is trading at steep discounts, we do believe that Russian exports will continue. We don't believe under that circumstance, which is the one that Washington is expecting, that Moscow will curtail exports in scale and kind of send a message to the rest of the world that it's curtailing output. But we do think that Russian output is poised to decrease about 1 million barrels per day from recent levels around 11 million barrels per day, closer to 10. As I said, just on those logistical and marketing issues. And what's going to happen in our view is that the incremental barrel of Urals becomes a little bit tougher to clear the market. We see that the flows through the Druzhba pipeline, the northern segment that had been feeding demand in Poland and Germany, those flows have not yet been fully halted. But as they tail off, as they dwindle, it could be tricky to reroute those barrels to the international seaborne market. And then likewise, if you think about demand for the incremental barrel of Urals, I mean, India has already, in a way, kind of done its job. It's already absorbed more than 1 million barrels a day compared to pre-war. And we have to keep in mind that its refinery systems do have continuing lifting obligations with national oil companies, including Mideast Gulf suppliers. And the oil market is going to find it.
Would you say on the Indian front, as you said, they've gone from 2% to 20+% of their imports from Russia. Why would that not continue? Yes, they will continue with their obligations to take on from Gulf suppliers, but we've had Indian commentators on this program saying that, as long as the crude is competitive, that's where we're going to take it from.
Yeah, and that's the key though, right? Is how competitive is it? And will Urals continue to be discounted enough to clear the market? The last few barrels that have to be continued to be reshuffled. So they've already done a lot. And to be sure, they are looking for the most competitive feeds for their refinery systems. At the same time, I don't think that probably India's total seaborne feedstock take could be more than a certain percent of Urals, given that it's a medium sour grade, and that other grades are also necessary for those refineries in the Indian systems to produce their slate of refined products profitably.
Okay, I mean, let's talk a bit about the other big consumer in the market, which is China. And of course, not only have oil markets had a bit of support in the last month on the back of that economy reopening, quote unquote, and that's obviously just started. But also, other markets, equity markets across the board have had this sort of everything's going to be fine and rosy because we've got, the world's getting back to normal. China's coming out of its slump. We'll talk about the US and Europe later. But again, some confusion over this reopening and how much and when and how soon it'll really hit net oil demand, if you like. Can you give us an outlook on that in your opinion, and particularly in light of the fact that, China's been sort of stocking up its inventories quite a lot in the last year as well?
Sure. Again, China is another one of the centerpieces for why we are supportive for crude oil prices later this year. And so China is going to eventually move past this very difficult phase of these sudden reopenings that have unfortunately increased outbreaks of coronavirus. But Beijing, in our understanding, is determined to drive economic growth this year. And so that's going to require even more lifting of limitations that still remain on transportation, on mobility. And that's like the main reason why we see increased oil demand and consumption of fuels from China this year. We think that we're also expecting a strong fiscal stimulus approach with a package of measures from the central government that's going to drive fuel demand, for example, in the infrastructure sector, big construction that runs on fuels like diesel. And we also expect Beijing to allow its independent refineries to import as much of that cheap Russian crude oil as they can. Private refineries in China have been running below capacity, we think around 70%. And that capacity itself is poised to increase by another, let's say, 10% or so this year. So that policy is also going to drive demand for crude oil imports.
Okay,
so when you put it all together, you've got a pickup in transportation, you've got fiscal stimulus coming, and you have this robust crude import and refined product export programs. We see China clawing back to and reaching again that important 16 million barrel per day of oil demand that it had before.
Okay, and what impact do you think all this demand is going to have on prices then going forward? We've seen, Brent and TI sort of go into these high 70s, early 80s in the last month. Where would you put your money on in terms of any ceiling that we might hit before any retreat?
Well, our expectation is that crude oil prices are going to increase in the first quarter. And right now we think that they could get back to that important, at least psychologically, $100 a barrel figure during the first quarter. Volatility, though, is really the name of the game in 2023, as we saw in 22. And we have these offsetting pulls on price sentiment in the oil market. We have geopolitical risk, as I mentioned before, that's continuing to pull prices higher. all other things being equal. But then we also have this really important macroeconomic risk, basically the risk of recession that's pulling prices lower. And we see a situation continuing this year where commodity exchanges and the risk managers on trading desks are going to kind of maintain a conservative approach, those sort of wartime limits that reduce liquidity in the oil futures market. I mean, the liquidity is a little bit higher than it was at its lowest levels, but it's still quite low. And you got to remember that when liquidity is low, price transparency is hampered. It doesn't work as well. And prices tend to overshoot really in both directions, to the upside and the downside. And so in the physical market, we've also seen problems with transparency. We were just talking about Russian Urals crude before. One of the interesting things that's going on right now in the physical market is that the participants who are buying and selling Urals, but particularly on the buy side, they've gone quiet in a lot of cases. And those price assessments are not picking up as many price signals and conveying that price transparency as you had when there were more participants in the past. And so in both cases, you have a problem with discovery and price transparency. That's why we're expecting continued volatility and overshooting, as I said, in both directions. But the near-term outlook is for support for crude oil, maybe moving back toward $100 per barrel. Not as high as we saw this time last year and in the spring when we got into kind of 120 and 130 territory.
Okay, so yeah, so I said the low volumes and lack of liquidity, if you like, will keep things volatile, as will all those other factors that you know, we could have a sudden about turn in the war, and who knows where that's going to go in Europe. But I mean, you mentioned you know, the impact of macro policy, and of course we've got this this program by the U.S. Fed, and Europe was was following suit for a while on bringing inflation down with its interest rate policy, etc. That's sort of settled down a little bit, and a lot of people are again, who criticize the exuberance we've seen in the last month, say, well, the lag effect of that has not been felt. So again, how is that going to impact? Of course, you don't have to know what the Fed's going to do necessarily for the next 12 months, but how much attention is the oil market paying to macro central bank policy in terms of its expectations on how to behave?
Well, like I said, we think it's one of the two big factors that is affecting oil price formation and market sentiment right now. When it comes to, we're not macroeconomists, and so we don't have in-house an independent view on whether there will be a recession. If there is, whether it could be worse in America versus Europe. You know, the IMF says that global GDP growth is going to be about 2.7% this year. That, if that's true, that would be very weak. That would be the weakest in probably 20 years. If you back out the immediate periods around the Great Recession in kind of 2009 and you know, the very beginning of the pandemic in early 2020 when everything came to a halt. But what's really interesting, I think, in our perspective, what's changed in recent months is we think that the recession risks are now more exogenous to the energy markets than they are likely to be spawned by them, if you will, because energy prices are lower versus the peaks that we saw last year. Natural gas prices have come off significantly versus their highest levels, as has crude oil, which we just mentioned, as have retail prices like US retail gasoline, which was $5 a gallon, unprecedented at its peak kind of last summer in June. So
that's a matter of, is that a matter of the demand reacting to those high prices last year, you know, demand destruction per se? So that's kind of, okay, that's how it's happened. Again, we may see the opposite take place this year. I mean, we're going to have the same cycle again. Clearly, the high prices did push demand down a little bit to an extent, and Asia. We
don't think it gets that high. So before we were seeing spikes to $120, $130 a barrel in crude, and the consequent spikes in fuel prices at the wholesale and retail level. We don't think we get that high this time around in the next rally, which arguably is already underway if you look at the recent trading period. So we're looking at more like $100 crude. And so we should see really important benchmarks for fuel consumption, like the retail price of gasoline US average, not near $5 a gallon again. But if we did start to move toward that level, we have market balancing interventions. You talked about demand, maybe not destruction, but curtailment at those high levels. That was certainly part of the story in mid-22, but we also saw policy interventions.
Yep.
And so we believe that, for example, in Washington, they're watching very carefully how the price caps develop on Russian crude and refined products, and how that will affect the prices of fuels that businesses and consumers are forced to pay. And we feel like there is a pretty low threshold for considering new interventions. The kind of the foot has come off of the accelerator, if you will, because prices are lower now, and because the advisory echelon has had a lot of time to study the issues in more detail. We think that they understand the costs in addition to the benefits of some of these interventions. But at the same time, if we start to move back even higher than we're forecasting, and consumers and businesses start to feel the pain, the policymakers will consider those interventions again.
Yeah, and of course, one policy is that this SPR release that happened last year, and if we hit the $70 again, they're going to start to sort of refill that. Supposedly, that's one intention. But let me ask you about the US and US production and US producers who still, despite these very high, healthy cost production prices, even for the US industry, are still not budging. And a lot of people are saying, that's it, the shale oil industry has really had its day. Yes, there might be one or two marginal big players still, but that the US isn't going to go back to what it was doing before, regardless of where we see prices.
Well, for our view, US oil production looks pretty stagnant this year. We're expecting only modest growth, like 4 or 5% in US total liquids production, and also in crude output from the lower 48 states, which is where the major basins of growth have been. And in a way, that actually means that the E&P sector's new strategy is working, because instead of delivering robust supply growth and treating free cash flow as kind of an afterthought, investors are really now in the driver's seat, and they're demanding greater profitability than before. So that means more dollars allocated to things like higher dividends and share buybacks and deleveraging corporate balance sheets and just generally spending within cash flow. And so we can expect an increase in upstream spending to take place this year, but a lot of that is just going to be keeping up with cost inflation for E&P, right? Because everything seems to be more expensive now than in shale's earlier years.
Okay,
I mean, if you look at all of the components, rig rates, fracking materials, specialized downhole equipment, even the labor that works in the oil patch, it's all more expensive now. And so US operators are basically going to drill and complete enough new wells to sustain production and avoid declines, right, to offset those declines, but really only modest supply growth, we think.
Yeah, and as you said, they have to keep drilling, at least not to have a decline, but they're paying more attention to their balance sheets and shareholders' returns. But what about investment in E&P elsewhere in the world? Again, there's been a drop in that since COVID, and even before that, it was sort of trickling to a slower pace. And people do say that unless we really have an uptick in that capacity, then these volatile prices are here to stay. And at the end of the day, and we'll talk about the energy transition just for a couple of minutes, but we will not be able. The world will have to keep producing to provide the energy that is needed for the next decade until renewables and other alternatives catch up. From OPEC, obviously, those countries are big producers, a handful of them. They had their own challenges last year with capacity as well. Is there a confidence in the in the industry that we're going to see more E&P investment across the board in general, regardless of region?
What's a huge concern right now, the underinvestment in the sector globally, and certainly in the Mideast Gulf. Many of the stakeholders have been pounding the table for months and longer, talking about the global challenge of sustaining those investments that are necessary to meet still growing demand worldwide. And we agree with that growth picture over the medium to long term. So it does continue to be a concern on a global basis. I think that there's some bifurcation in planning, certainly between long cycle projects and short cycle. We were just talking about US shale and tight oil here in the States, there is still a place in the global kind of supply stack for the long cycle projects as well. But until we have more clarity, as you alluded to, on transition, decarbonization targets, and what investor appetites will be like around the world, it's hard for people to pull the trigger on those longer cycle capacity additions. And I think understandably so.
Okay, and would you say that the war in Europe has and the whole concept of energy security, if you like, especially for Europe itself, has that derailed the conversation around the transition within Europe, would you say, or is it all systems go still, and from an investment point of view, in continuing with those agendas?
Yeah, I think that the biggest change that's probably evolved from the invasion and the consequent war, probably to no surprise, is just the security of supply. And as we reshuffle barrels from one major world producer from its traditional market, which of course was Europe, for much of crude and certainly refined products, to places east of Suez and continuing buyers in non-OECD Asia, the market has to rebalance. And the market, most importantly, has to identify and prove the validity of new trade routes to be economic and reliable. And that is a discovery that is currently taking place toward the end of last year, beginning of this year. We're seeing that story play out in real time. And the big question on traders' minds, and I think investor minds as well, is will these markets clear efficiently? Will supply continue to be effectively delivered to demand, given these new, let's say, exogenous limitations because of sanctions, import bans, embargoes, et cetera? And that's one of the big question marks as we set the table for 2023.
Okay, and Clay, just maybe one more question to you, big picture question before we wrap up. You know, there's been a lot of talk last year amidst this sort of energy security challenges for Europe mostly, but of course Asia felt the brunt of high gas prices, etc., and even gas supply was being pulled into Europe, which was paying more for it. But there's a lot of talk about this new global economic order, if you like, i.e. the US-China trade spat versus the Russia war versus what the Gulf producers are doing and who's taking a neutral stance on the Ukraine war and who isn't in terms of global powers. But would you agree that there is a new global energy order being established that is irreversible in terms of new trade flows, possible use of new basket of currencies for oil and energy, etc., or once Ukraine is over, we'll go back to normal?
Right. Well, I slightly hesitate on irreversible because it's so permanent, but that clearly the direction of travel is, as you said, to a new order of energy geopolitics and connecting supply with demand. It's hard to see how at this point, even if the war ended quickly, which is not our expectation at Rapidan Energy Group, but even if it did end quickly, how Russia's position as a key reliable supplier to Europe and other parts of the world could be restored. That change looks to be quite permanent and long lasting. I think that also just sort of the energy dimension of this geopolitical balance of power, it's a little bit stalemated right now if we look at the situation with the war in Europe. I mean, Europe has really quickly rebuilt its gas inventories during a warmer than expected winter so far. I think that's lessened the leverage that Moscow has had on their Western adversaries. Sanctions have, to a certain extent, reduced Russia's oil revenues, but they are apparently still adequate for the time being to continue the war and to maintain President Putin's position there. And both sides have really declined to play their strongest energy cards if push really came to shove. As I said before, we don't expect Moscow in this environment to curtail exports in scale. They want to keep the exports flowing, and the West has designed a price cap that has effectively kept the exports flowing. The West, for its part, isn't playing its strongest cards. It's not brandishing secondary sanctions against those continuing customers of Russia. And it's certainly not talking about sanctioning the Russia energy companies themselves. So with both sides kind of holding back their strongest cards, we have a little bit of a stalemate in this geopolitical dimension of kind of the new energy order.
Waiting for the next surprise. Clay Seigle, thank you very much, Director of Global Oil Services at Rapidan Energy Group. Thanks so much for joining us on this week's Halftime Talk.
Pleasure to be with you today. Look forward to next time.